So we're going to show a few slides that will tell you what's going on here in our local Santa Clara County area. I'll turn it over to Doug, and he's going to give a presentation, but leave lots of time for questions. So I'd like to introduce my good friend, Stephanie Baldrini.
We're going to be talking about Silicon Valley trends and what is currently happening in the Bay Area. So the market of residential is, believe it or not, still very competitive. And that is because we have a short supply of properties. So we have a short supply of properties for sale because sellers know that they cannot get the same price that they could just a year ago. And they cannot get the same price because buyers cannot afford the same price, obviously, because interest rates right now are pretty much double what they were last year. So their mortgage payments are significantly higher, and therefore there is less supply in the market. So if you take a look at the white column there, it's a 3-year overview of supply. We'll look at the April months, which are the white ones. If you look at April 2023, which is right now, and if you compare to 2021 and 2022, we are currently at a 43 to 50% less supply in the market today. This slide is a very Silicon Valley slide. The median days on market is still pretty mind-blowing. 8 days, median days on market. So sellers still have the benefit of having buyers. The buyers don't have enough homes, so when they find a home that fits their criteria, it's clearly still going very, very quickly. The median home price has decreased 8.6% over the last 1 year. However, as my dear friend Tom likes to say, real estate is a get-rich-slow scheme. So we cannot just look at 1 year. We have to look at a full decade. And we have been very blessed in Silicon Valley who have had 126% property price increase over the last decade. This is my last slide. It's about commercial real estate investing, which is what I do. We don't need more than one slide to explain what is happening in commercial real estate in the Bay Area. And this is particular to San Francisco. San Francisco is not unique, though, despite going through a very incredible time right now. LA and New York is also experiencing similar things. So there are two things that I want to highlight in this slide. Number one, all of these headlines came out 1 month ago. All of them. Imagine what's going to happen in the next few months. The other thing I want to highlight is that there are 3 different asset classes in this slide. 3 different asset classes are hurting right now, at least in San Francisco. So if we look at Hilton, San Francisco, in Union Square, that is one of the largest hotels in San Francisco. Along with Park 55, the owner returned the keys to the bank last week. Nordstrom announced that they are going to be leaving San Francisco for good, along with several retailers. Imagine how much more retail space will be available in the city. And last but not least, office, of course, is the one that is hurting the most right now. We're currently at a 33% official vacancy rate. However, the real one, I believe, is around 50 or 60% because we still have people that have leases and they're not using the office. So it's all of these office spaces are out for sublease. So this is the state of real estate. There is an office building that recently sold in San Francisco for an 80% discount. It is a contract right now for $130 a square foot. This is unimaginable. With that, I will pass to Tom who will introduce Dr. Duncan.
15 or so years ago, I had the pleasure of meeting Doug, and we became good friends, and I invited him to speak at the San Jose Real Estate Investment Club, you need to understand that prior to the pandemic, Doug was typically invited to 300 events a year, and he accepted 100. And one of those that he would come to faithfully every year was our investor club here in the area. And he says, Tom, I love being with Main Street. I love, and your Main Street people were pretty knowledgeable and asked really good questions. So yeah, there's going to be plenty of time for questions at the end. Doug is the Executive Vice President and Chief Economist of Fannie Mae. He probably has one of, if not the largest staff of people studying the economy in the country, certainly. And he doesn't always trust the data that comes in from other surveys. He does plenty of surveying from within his own group, so he gets data that he knows he can rely on and ask questions that aren't always asked out there. So it is a real honor to have him back, and it's a great pleasure that I introduce my good friend, Dr. Duncan.
It is great to be here, and what Tom said about getting together with people on Main Street, people that are in the business space, I really enjoy that. And I think it's one of the, Tom had put up, I guess, the Lawrence Klein Award. I would attribute that to our staff getting out onto the street and talking to people, not just running models in the office. But it's not just me that goes out and speak. I have 3 vice presidents, all of who probably speak 20 to 30 times a year in different places. And I have some more staff under that also do that. Because I just feel the economy is a dynamic organism, and every single action that you take impacts the direction and the intensity of economic activity. So if you're not out there trying to understand what people are doing, you're probably missing the bigger theme. So I really enjoy this. I told Tom and I were talking about Q&A, and I said, I always issue a warning. I said, if you ask me a question I don't like, remember I'm from Washington, so I'll answer a different one. So they do on the talk shows. So I'll go through a few, let's see if I can get this. I have to point it at the. No? Okay. That just says Fannie Mae will deny I was ever here. So each year I spend time in December and January thinking about what is likely to be the underlying theme for economic activity over the succeeding year. The reason I do that is it's a check against ourselves. It's actually, the team does this. I want to know whether at the outset of any time period, we had a good feel for the major impulses that were underway in economic activity, in particular housing, because that's the business Fannie Mae is in. And then we use that to test ourselves across the course of the year. What did we miss, if anything? Were we just lucky? Did we just make a lucky guess? But it's also something that we can hang the discussion on when we're talking with people out speaking. So, interesting little factoid. The optimal number of words for that theme is less than 7. People will remember it if it's less than 7 words. If it's more than 7, it gets lost. So this is for awaiting improvements in affordability. It's not just affordability in housing. The rise in interest rates means affordability across the economy, credit affordability, that kind of issue. So it's intended not just to focus on housing, though it certainly does apply to housing. So far, I would say I would give us a B at best, because housing, even though we started the bandwagon on the fundamental fact in housing would be a shortage of supply back in 2014, even we underestimated the mismatch between supply and demand when interest rates made a significant rise. So what Stephanie was saying about the supply issue is still very true, and still intense competition really all across the country. Though I'll show you a map in a little bit that shows red or falling prices largely dominate the West, and green or rising prices dominate the East and Midwest. So it's as it's always true, all real estate is local, and you have to understand local markets to build the big picture. So okay. So this is a quick run through of a set of things that we watch. So obviously, we're, as is the Fed and everyone else, focused on the question of inflation, which rose much faster and much farther than was anticipated. We had anticipated a rise. We did not anticipate how far it went. But we did say, when the chairman of the Fed noted that from his perspective this was transitory, I got out my Oxford English Dictionary, which I sit next to my computer. I assume you all do as well. No? So I looked up the word transitory. It says not permanent. Well, by those terms, life is transitory. So we said, we don't believe that. We do believe there are some bottlenecks in supply chains because of the risk of COVID. And so the institutions are going to have to adjust their practices to ensure the safety of their workforce. But once that's in place, some of those bottlenecks will go away. But we believe there's something more fundamental than that. We believe that geopolitical change is going to lead to the restructuring of supply chains, and that's time-consuming and expensive. So the Fed is going to be leaning against the restructuring of supply chains, and you're seeing the stories emerge now, right? About how difficult it is to re-platform your company from one country to another country, to strike relationships, shipping and other kinds of transportation relationships. Restructuring those things, time-consuming and very expensive. So we felt like that we got ahead of that one before some others did. So that's going to be a contributor to the underlying rate of inflation for some time. Obviously, the Fed has been very focused on the labor market. So a couple of things to note. In the upper right-hand corner, we're back to, for working age, or for prime working age, 25 to 54-year-olds, we've gotten back everything that we had prior to the pandemic, and we're actually back to the participation rate that's around the year 2002 or thereabouts. But if you go back further, labor force participation was higher than that, and I'll show you another employment chart in just a minute. Obviously, the Fed has raised the Fed funds target pretty substantially. On this, our average hourly earnings, it looks like in 2022 that there was a burst of growth in incomes. That's a little misleading in that it's a summary of those people that do have jobs, and service sector employees earn less money, and there was a slower return of service sector workers to the market, which meant that average rose because of the truncation of the participation of the service sector workers. So it's a little bit misleading in that regard. So the millennials are here. We were talking, somebody and I were talking earlier about the stories that had emerged back in 2010 or thereabouts, that the millennials had learned the lesson of the foreclosure crisis, and they wanted 300 square foot apartments with amenities because their parents all had gone through foreclosures. That didn't make sense to us. So we started a survey, which we continue to this day. Once a month, we survey 1,000 households structured to represent this population. June of 2010, the first survey, 92% of millennials said we eventually put on. So how did we square that circle? That recovery was the most urban-centric recovery in the U.S. since World War II. So if you're going to have a job, you're going to be working and living in the central city where they don't build single-family detached houses. They build apartment buildings with 300 square feet and amenities. What they were really saying is, we want a job. When we have a job, then we can build a credit record, and then eventually we're going to get partnered up, or, as my mother would say, benefit from clergy. and form a household, and then will buy a house. And that's exactly what they've done. You can see they are not yet at peak median home buying age. That's still a couple of years off. They started driving the demand curve in 2015. And by that time, the builders were already behind the curve, and we're still living with that supply shortage today, and that will continue for some time. On the lower right-hand corner, I mentioned I would talk about another chart on employment. The top line is men's workforce participation, which you can see has been declining since, well, this data goes all the way back to 1960. It's been declining across that whole time period. It was disguised until the year 2000 by the rise of women's participation in the workforce, which peaked in 2000. Once that peaked, it revealed the fact that men's labor force participation had been declining. To me, that is a societal, a societal problem that is as of yet unaddressed. And you can see perhaps some evidence of what's happening in the upper right-hand corner as we're near all-time peaks of adult children living at home with their parents. Part of that is the housing supply problem, is there's not a place to live in cold. And by the way, apartment buildings, there's also still a significant supply issues in the apartment space. So here's a few items on the, to paint some other characteristics of the housing market supply issue. So in the upper left-hand corner, it's a look at the housing stock available per household. And what you see is it's close to its lowest point over the last almost 40 years. So that's another way of looking at that supply problem. Below that, you can see existing homes and new homes. The new home number looks like a big rise in available new homes. It actually includes lots that are available for sale for development. So it's not just the finished houses available for sale. On the existing home thing, my favorite statistic for the last couple of years was, I think it was 2 years ago, there were about 1 million realtors and about 1 million existing homes for sale. So each realtor could sell so upper right-hand side, the housing, there is a typical relationship between housing and the business cycle. As the Fed tightens on anticipation of the rise of inflation or in response to the rise of inflation, interest rates go up. Housing is a very interest rate sensitive business. The first thing that happens is residential fixed investment, which is economic jargon for building, starts to slow. Then the next thing that happens is new home sales start to slow because builders are building less, and so there are less being sold. Then existing home sales start to slow. And then when the recession is full force and the Fed eases, rates come down, construction starts to pick up, new home sales start to pick up, and existing home sales start to pick up. So there's a predictable relationship. Typically, that was not the case in 2007 to 2009, because in that instance, the center of the financial problem was the decline in underwriting standards in real estate itself. So it was the sort of the core of the issue. So you can see in the upper right-hand side that permits for single-family construction have fallen. That's the response to the Fed raising interest rates. And I think, as Stephanie said, they basically doubled interest rates in the course of a year. So you saw that response. In the lower right-hand corner is the Fannie Mae house price. We forecast prices on a quarterly basis. The primary application of that within the company is establishing the allowance for losses. And so it's probably the most important variable for us from a management perspective. But our view is the calibration of it on a frequency more than order has a lot of volatility to it. So we have forecasted in alignment with our public statements, our public filings. So as you can see, a big drop off. Now, as I said earlier, I was giving myself at best a B on our forecasting part because our, if you went back 6 months and looked at our forecast, you would have seen that our view was over a 2-year time period, peak to trough. We thought prices would fall about 10% nationally. Now, with what we've seen in the last few months, we think half that, probably only about 5%, which suggests that the supply shortage is a lot more powerful than you would have thought, given how fast house prices appreciated 2 prior years. Tremendous appreciation in some markets, 40% or more over a 2-year time period, and even those markets are coming down a bit, but nothing close to 40%. Now, part of that is simply because transactions are not taking place. Because, and I'll show you a chart in a little bit, over 90% of all outstanding mortgages today are at least 100 basis points below the current market interest rate. Something like 78 or 79% are 200 basis points or more below the current interest rate. Those loans are going nowhere. So it actually has impacts in several places. One of them is accentuating supply shortage because people are locked in. They're not willing to give up those mortgages. It's also slowing the pace at which mortgages prepay in the Fed's portfolio. The Fed is the single largest holder of mortgage-backed securities in the world. Banks and other depository institutions as a group are larger, and I'll show you that. They're about 29%. The Fed is 20%, 21% of all outstanding mortgage-backed securities. They've gotten out of that space, and that, in our view, is part of why those are staying higher than you might have thought. So there's a map of selected markets, house prices, where we think we can validate. It gives you an idea of why real estate values are changing in different ways regionally. We'll talk a little bit more about that. Okay, upper left-hand corner. This, we ended 40 years of declining nominal interest rates. So for about 6 or 8 years, I had been pointing out to bank leadership teams when I spoke to them that they now had no one in senior leadership who had ever managed a bank in a rising rate environment. And they might want to think carefully about, even some of them may have had directors on their board of directors that were more senior and had been through some of that. This is over 40 years of declining and then flat, near zero interest rates. So business models and mental frameworks had aligned to that reality. And it suggested it might be difficult to recognize risks that exist in a rising rate environment. Of course, there were a couple of banks not far from here that had a little bit of difficulty. So there's a couple of things to think about. The most interesting fact of the failure of Silicon Valley Bank was that $42 billion left that institution in 6 hours. $42 billion in 6 hours left that. So there's probably a reason to think more deeply about how technology has changed speed in the actions that we take. on whether or not our the institutional structures we have in place are resilient to that to the enabling of rapid changes like that. Now, there's a bunch of interesting things about that. It shows you that economists have no feelings, right? Interesting things of bank failure. How interesting. So what did we learn? One is that technology has changed behaviors, and what we thought of as a bank run in the past is not what a bank run will be in the future. Because people can, with a few strokes of their cell phone, relocate their financials to another institution, and that leaves very little time for the affected institution to respond to that. And so bank regulation is probably going to have some review. Second thing is we proved there's a class of banks in the United States that are too big to fail. There's about a dozen of them. And the hot money from Silicon Valley Bank flowed to most of it flowed to those institutions which had nothing to do with yield. It had to do with safety, because they're paying 25 basis points of interest or something like that in accounts. So it wasn't about yield, it was about safety. So that was one thing we learned. The second thing that we learned is those too big to fail institutions do not do well in local markets. Otherwise, we wouldn't be talking about the regional banks and commercial real estate, particularly office. Something like 75 or 80% of that credit lies in the portfolios of the small and mid-sized regional banks, which means that the big banks don't know how to compete with them. That's important because those institutions are key to the health of those local, smaller and regional markets. We'll see. There is already some talk of change of capital requirements, but imposing additional capital requirements on those mid-sized firms will probably aggravate the disadvantage that they already have in terms of the cost of capital. If you're too big to fail, the risk premium that you have to pay for people to do business with your bank is lower, right? So we'll see where regulation goes on that. But a couple of very important things, I think. Excuse me. Okay, so I mentioned the Fed and its portfolio. Right now, the spreads in the mortgage space are historically wide. So if you look at the spread between the 10-year Treasury and the current coupon yield on a mortgage-backed security, it's far wider than it's normal. Part of that is risk. If the market sees a potential recession coming on, in which case delinquencies would, if unemployment rose, you would see delinquencies rise, representing an increased risk. So the market, to some degree, is pricing in that risk. But it's also, I think, pricing in the question of when the Fed exits, who replaces them? And that's kind of an unknown. If you go back in history, it was the thrift industry that held, they were by definition designed to hold mortgage credit. Then when the thrift industry died, it went to the GSE portfolios. And when the GSEs got in trouble and their portfolios were constrained, then it shifted to the Fed. So the question is, to whom does it go next? That's an open question. I don't know the answer to that. People will say private investors. Well, okay, that may be. What yields will they require? And how will they behave over the business cycle? And how will that impact volatility funding in the real estate space? So I think that's an open question. We're working on it from a research perspective and talking to a lot of people that have ideas on that. I don't know the answer yet. I don't think that by and large it's going to be foreign investors, partly because of the geopolitical issues that I was talking about earlier. You can see in the lower right-hand corner the Fed's portfolio, something on the order of 80% or more has a coupon of 3% or less. So that's going nowhere. But they've said they want out of the MBS investment space. Upper left-hand corner, that's what I was talking about earlier, 90% or more of existing mortgages, 100 basis points below the fair market rate, something on the order of 75 to 80% are 200 basis points below the current market rate. So little refinancing. These are some other risk metrics in the GSE portfolios. And what is the takeaway from this is that the layered risks which existed in the 07 to 09 downturn do not exist today. So if you have a spotty employment record, but you have lots of savings and you have a good payment record, you can still get the credit. But if you have both a spotty employment record and a spotty payments record, even if you have a lot of equity, you're probably not going to get that loan, or at least not at the price that you're looking for. So layering of risk has largely been removed from anything that the GSEs had done. One thing that has moved up is the average debt to income ratio, and that's again an artifact of the supply issue. There's the holders I mentioned to you, the 29% held by depository institutions, 21% the Fed, and the rest distributed in multiple areas. So that 21% is going to have to be picked up by someone else. It's likely not going to be the banks because they tend to hold things in a very narrow band over a very long time period, and they're pretty close to the top of that band. One of the things that we've been thinking about recently is what will the boomers, as they move to retirement, do with the equity in their homes? So, and I know a couple of boomers. You don't get to say anything, Tom. But there's a significant share of the boomers for whom a significant part of their wealth is the equity in their home. And they may or may not have enough for late life issues. And the question is, how will that equity play a part? So one of the things we did in the lower right-hand corner here is we looked at different age groups at different points in time. So on the far lower right corner, for households that are 65 to 69 years old, you can see that in 1990, that population group, about 90% of them were debt-free. Then that fell to, 70%. In 2015, it fell as low as about 50%. It's picked up a little bit in 2021. It was something like 53 or 54% of folks that were 65 to 69 still had a mortgage on their property. Now, some people say, well, gosh, they're going to retirement with more debt, whereas the earlier generations would have reduced the debt. Well, they also are going into retirement with more assets. So if those assets throw off income to service the debt, then it's not really a problem. But it is true that they are carrying more debt into a retirement than some prior, the same age group in prior decades. So we're trying to monitor that. From a credit quality perspective, the mortgage book of credit is extremely healthy. The GSEs in particular, FHA has seen some pickup in delinquency. Part of that is when interest rates were at 3% or 2.5%, people were refinancing their FHA loan into a conventional loan to get rid of the mortgage insurance. So the best credits were exiting the FHA portfolio, therefore raising the average delinquency rate remaining in that portfolio. That's a rational behavior by consumers. It's just that it changes the profile of the FHA portfolio. In the GSE space, almost no delinquencies, historic low levels of delinquency, very solid book of business. Single family rental. That was one of the first things that I talked to the investor groups that Tom talked about me coming out here 15 years ago. was trying to get a handle on what is that business. Fannie Mae actually has about $360 billion of single-family investor-owned rentals. Most of them are moms and pops who bought a house, outgrew the house, but kept it as a rental and bought another house. And so they may have one or two properties. We actually have a limit on how many properties we will, how many loans we'll make to individual investors. But this is it's a space that where memories have been short. So in the 2007 to 2009 downturn, the single-family investors were key in transitioning foreclosed owner-occupant homes back into the housing stock, improving them and putting them back in as rentals. So they actually helped transition an excess supply, if you will, driven by the rise in foreclosure, back into productive use in the housing stock. Today, they're looked at the other way. They're keeping people from buying their first time home by putting them out there as a rental, as an investor. I think that's patently misunderstanding how market fundamentals work. So I thought I would give you a little bit of data on the size of that market and a couple of interesting facts that are often overlooked. So in the upper left-hand corner, it gives you a feel for how many properties there are. If you go back to 1970, there were still 14 million single-family rental. So this is not new. That's 50 some years ago. 14 million single-family rentals. That grew up until about 1990. Then it flattened off for a while. Fell a little bit prior to the 07 09 downturn, and then we saw the pickup of it again as a business with the institutional investor coming in the first time. And they were able to come in because the prices fell so far that with modest investment of improvement, they got very good returns on the rental price. House prices had never fallen that far before, so that never created the opportunity for the institutional investors. But they're still, as you can see in the upper right-hand corner, they're still a very small part of that business. Less than 10% of single-family rental homes are owned by investors. So there's a lot of talk about Wall Street money in the single-family rental space. There's more talk than there is money from them. It's still the case that the moms and pops are the most significant owners. I would argue, and nobody ever talks about Gen X. Talk about Gen X for a minute. The Gen Xers are the folks that have 2.5% to 4% mortgages. So they're going to be the ones that will become single-family rental owners. Because when they make their next move, they will probably keep that 3% mortgage because the mortgage payment on that is less than market rents in most markets. So it's likely to be the case that they will become single-family rental investors. Some people will have an incentive to move if you're going from a very high-priced market. I've heard there are some in the area here. To a low-priced market, you may be willing to sell the house and give up the 3% because the decline in the size of mortgage you'll have to buy a lower-priced house will offset the difference in interest rates and equal. So that some households will be able to make that transaction. But I think some of the Gen Xers are going to be single-family rental owners. In the lower left-hand corner, this is one of the things that I think is really important. That the single-family rental will keep aging properties in the housing stock. So the average age of single-family rental homes is probably 10 to 15 years older than the overall average. And so they are actually keeping properties in the housing stock, which is hugely important, especially given the shortage of housing relative to the level of demand in the market today. So I'm very friendly to single family rental folks. This is our forecast. The summary, and all this stuff is available to you online. Tom, I don't know if you're planning on distributing this to if folks want to. You can have access to this, so you don't have to take a picture and expand it, about the percentage signs and all that kind of stuff. Basically, 2023 is sort of a give back. Some sort of a subliminal message. 2023 is basically give back for the very good time that the industry had from the middle of 2020 to the middle of 2022. But it's not as much of a give back as we thought it was going to be, because in fact, the supply demand characteristics have held the market up better than what our initial forecasts were. So somebody said to me in the reception before, well, of course, the $100 question is what are interest rates going to do? So I'll come back to that for a couple of minutes, and I'm going to show you two more charts and then take questions. Our view is the Fed will skip increasing in the next in the upcoming meeting here in June. It will not change rates. Some economists, head economists, normal people wouldn't talk like this. Somebody said, well, it'll be a hawkish pause. So yeah, that's probably taking the English language beyond its capability. So what they meant by that is their instincts tell them that they need to raise further, but they are also knowledgeable about the fact that monetary policy takes time to take effect. And you can see every time the Fed breaks something, there's usually a bank that fails. Now, I don't view the Silicon Valley Bank failure as that bank failure. That was a liquidity issue. Remember, the Silicon Valley Bank's assets were good assets. It's just that market rates changed so that if you held those treasuries to maturity, they would pay out. If you held those mortgage-backed securities to maturity, they would pay out. But if you had to liquidate them, you were going to liquidate them at a loss because market pricing had changed. So it's not that they invested in bad assets, which was what happened in 07 to 09. That was an asset quality issue. Because we ran the experiment of what if you give a large amount of money to people to buy a house, give them 30 years to pay back, and they don't have a job. Didn't work that well. Right? But that was an asset quality issue. This is a liquidity issue. So I personally don't think we're done with this. Remember, it was 6 months and 2 days from the time Bear Stearns was taken over until Lehman failed. So we're only about 2 months into this. And you're hearing the stories about office space and loans that are underwater. Some people are going to have to turn properties in. You heard Stephanie make note of the Hilton. I think that was an important signal about that there are still issues to be observed in the banking system. So that's not going to stop the Fed from raising rates again. I believe they will raise again in July. I don't believe that they will reduce rates until significantly into 2024, and that's if there is a recession. So if you listen to Powell, I assume you all go online and watch the press conference, right? That's the equivalent of a cocktail party for economists. Yes, parse the language. If you have too much wine, language parsing thing can get lost in it. He said the same thing multiple times. He said, it doesn't matter how fast we go. It does matter where we stop. And we will probably stay there longer than you think. So why is he saying those things? There's some history here. This is Doug's view of what he is likely thinking. He has not told me this is what he's thinking. So, you can take that to what it's worth. When Volcker was appointed, he immediately attacked inflation, and they did start to see some decline in inflation from very high levels. They also got a recession, which started in January of 1980, and because they started to see inflation move down, they stopped. In fact, they eased a little bit, and inflation took off again. So they had a 7-month recession, a little bit of easing, and inflation took off again. So they had to tighten hard, and they got an 18-month recession. That's where the term double dip recession comes from. It's that episode in history. So I believe that Powell, when he says we will stay higher longer, is saying we're going to prevent there being a double dip. So that's one thing that he would like to manage. I believe it's just Doug's view. The other thing is what's called the Greenspan put. So you've observed the Fed will have a meeting, and the forwards 3 months or 6 months out suggest that they think the Fed's going to cut. They've been doing that every meeting. The forwards, the next few months forward, the Fed's going to cut 3 times in this year. We have not been in that camp at all because he says, and I believe he means it, we will stay higher longer. He would like to banish the Greenspan put. What's the Greenspan put? Greenspan was asked, how should the Fed treat bubbles? And he said, we don't know until after the fact, truthfully, what is a bubble. So what we will do is calibrate monetary policy focused on inflation before it bursts, and then when it bursts, we can act quickly to cushion the downside. But that came to be recognized in the capital markets as privatizing gains and socializing losses. So the market is signaling we want that same thing to continue. And Powell is saying that has adverse economic consequences long term because it leads to a misallocation of resources. And so I believe he wants to eliminate the Greenspan Bernanke Yellen put, because it's been carried out in all those administrations. So I think those are the two things that he's attempting to do, which I respect him for. It will likely be painful. How many of you were in the business in 1980? Remember the builders taking lumber to the White House and throwing it on the lawn? The farmers took their tractors there and tore up the mall. It was a very turbulent time period when they really went after inflation. So the other thing Powell wants to do is make sure we don't get to the level of inflation that could invoke that social disruption. Of course, today there's not enough lumber to throw at the White House. But I think that's the other thing that he's working against, and I think we'll all be better off if they're successful in getting inflation back down. Okay, I promised you 2 more charts. This was my favorite chart 2 years ago. I have it on a T-shirt. I was giving speeches and I told people, I said, I'm threatening my staff that I'm going to have this chart put on a T-shirt and make them wear it. Somebody was in the audience sent me a dozen T-shirts with this chart on it. So, why do I like this chart? This tells the story of today's supply problem. So what it is the relationship between price signals and supply response. So it's tracking the year-over-year appreciation in house price and the population-adjusted change in housing production. And as you can see, the price signal produced exactly the response that you would expect. When prices rose, it invoked an increase in production. When prices slowed, production slowed. Until 2008. Very close correlation. That's a really close correlation. So the market was doing exactly what it thought. So what happened in 2008/9? That's the bust. So we went from building 1.6 million single-family homes on an annualized basis to building 400,000. So we destroyed 3/4 of the supply chain, and then we held at that level of 400,000 for 3.5 years. So all those people that were in the supply chain when we were building 1.6 million units, 1.2 million, the labor that was aligned to the 1.2 million of that 1.6 wasn't just sitting on the phone waiting for it to ring for 3.5 years. They were moving on to other things. The people that were producing PVC pipe for 1.6 million houses now are only producing PVC pipe for 400,000. And it's not my mother. And so because of that downturn and the destruction of the supply chain, the construction side was behind the curve already by 2010. And they didn't really start growing again until about 2012. We have never caught up back to that destruction of the supply chain. One other little lesson, what's this hump in the dark line in 2010? Be brave. What it was, that jump in the price line, of the dark line in 2010.
7,000 tax credit incentive.
First time home buyer tax credit. In a market which has inelastic supply, if you change price, change the terms, you'll get a price response because it takes 9 months to build a house. So what happened was, as soon as people were eligible, they bid up house prices because the supply curve can't respond to that fast. When the program ended, prices reverted to the prior. So, very important policy lesson here. Think about the structure of the market you're trying to impact when you make policy change. Because basically, all those people who bought as that home was building were underwater when prices fell back down. Now, eventually, it's a major difference. They came back out of that, but very important policy point. This is my favorite chart now. I call this the barbed wire chart. It's because I grew up in a dairy farm and I had to string barbed wire, and it's a painful process. What's going on here? On the vertical axis is the relationship of household income and household price. So it's a fundamental view that a household of particular income can only probably afford a house at a particular price. So there could be some sort of relation there. It's moderated by the use of credit. So if you have to use a mortgage to buy a house, the higher the interest rate, the lower the ratio of house price to your income is going to be. Right? If interest rates fall, house price can rise relative to your income. So that's all this chart is showing, and the dotted line shows it's a very predictable relationship. Those two things intersect in a very predictable way. Then you can see out in 2002 the easing of underwriting criteria that led to a non-supportable expansion in house price. Then when the reality of those loans not going to repay hit, you saw that bubble burst. House prices fell down below the line. We went through the 09, 10, 11 foreclosure crisis. And then the market started to clear again. And for about 4 years, we were right back on that dotted line until the pandemic came. And that again put the builders behind because they had to stop production for 2 reasons. We lost 20 million jobs. So the question of what is real demand going to be in housing? And also we need to protect our workers. And we have to figure out how to build houses while keeping our workers safe. So they probably got 4 more or 5 more months behind on the production process from where they already were behind. And then when all the stimulus money flowed in, a family of 3 that was below all of the maximums for the program, if they saved the money, would have saved about $14,000. If they used that in a 3% down payment mortgage, if they had good credit and used it for a 3% down payment mortgage, that's about $380,000 house. So you can see why low priced houses accelerated in price appreciation faster than mid or high priced houses. What you can see also is we're still quite a ways from coming back to that line. So there's 3 ways we can get there. Interest rates can come down, house prices can come down, or incomes can go up. I would prefer that third part, because part of what got us in trouble was income transfers as opposed to income growth. So if fiscal policy were to be redirected to generating income growth and investment to increase productivity, that would actually be the best thing that would improve affordability for households to buy and sustain a house. So I'm going to end there and not expect a change in fiscal policy anytime soon. And that was a cynical statement. Sorry.
Silicon Valley Bank and what amount of time?
$42 billion of deposits transferred in 6 hours.
So which bank executive was that took it out?
It's probably a neighbor of yours, not mine.
I was looking at the balance sheet of Too Big to Fail Bank, and I was looking at the footnotes, and I saw there's stuff, a lot of asset-backed securities, MBS, these special purpose entities. Does that fit within the band, or it is off balance sheet, those special purpose entities? Is that an additional risk to the system?
Well, that was an issue in the downturn in 07, 09. The special purpose entities turned out not to be as divorced from the institution as they thought. Capital rules have changed to strengthen that separation. We won't know until it's tested again whether those changes were sufficient. It is more an issue in the bigger banks than it is in the smaller banks. Fewer of them have special purpose entities. And they also have less of the more, I guess you could call them exotic asset classes in them. Well, somebody told me the other day, exotic is a word better applied to dancing than to mortgage issues. Probably agree with that. So I don't think it's riskless. And there are certainly the big banks, there are ways that they could get in trouble, but the capital advantage that they have from being too big to fail can be overtaken by smaller and mid-sized banks. Will we have a recession soon? A year ago in April, we put in our forecast that in the third quarter, we would begin a mild recession. The third quarter of this year, we would begin a mild recession. So,
don't have to be polite to say it.
we still believe that we will see a recession for the Fed's taking.
What is mild?
That's actually in the forecast. It's 0.5% of GDP shrinkage. So 0.5 reductions in GDP. That's mild. The reason we said it would be mild is housing. Because we are well aware of the business cycle and the housing's relationship to the business cycle, but also the supply shortage. So we felt like housing would actually provide more of a support. And it's doing that. It's actually doing better than even than we had thought, and providing some support so that then they get their software. I won't be disappointed if they do. But if you look at the Labor Department report from last week, it depends on which part of it you want to look at. The unemployment rate went from 3.4 to 3.7% in 1 month. If we see another month like that, then that may, because unemployment is a lagging indicator, that may be indicating that we're already moving into a recession. The one other variable that the Business Cycle Dating Committee of the National Bureau of Economic Research, which is the group that determines when the recession started and end, one of the things they watch is gross domestic income. It's similar to gross domestic product, GDP, which people are, but it measures things from an income perspective. It's been negative now for 2 quarters in a row, and that tends to lead to recession. Yield curve deeply inverted, that always leads to recession. There's a series of things that are signaling recession, but the consumer, you can go wrong betting against the American consumer.
I think that the risk from the commercial real estate space, which most people are focused on office, is that there are people who have bullet loans out on the commercial side that they will not be able to handle the reset. And so they're going to do like Hilton did, they're going to toss in the keys. If there is a string of that, which there are in the next 3 years, there's quite a few maturing commercial loans. If there's a string of that raises the risk to the banks and whether or not the banks can survive that. If it starts a string of bank failures, that restricts credit, and that certainly will bring on a recession. The magnitude of it depends on what the policy response is. But I told some folks before the event, there isn't enough jargon in our business, so I coined a new bit of jargon, which was the geospatial redistribution of real estate value. What do I mean by that? Okay, what I'm intending from that is the work from home experience has suggested that the geography in the relationship between an employer and an employee may well have systematically changed. So that would revalue different kinds of real estate depending upon how that redistribution impacts their business. That's part of the office space question, right? If you can work from home. Fannie Mae went in 3 days from 8,000 people working every day in an office to no one working in the office. That was a real income increase to every Fannie Mae employee because their commuting costs were converted to consumption in other categories. Taking that back, you're telling, if you're going to require people to come back to the office, you're telling them you're going to take a pay cut and come to the office because you're going to pick up the commuting costs again. So it's not surprising there's resistance of people to not going back into the office. But it's also not surprising why people who have investments in office buildings are concerned about it. Right? That's what I'm talking about when I use that piece of jargon. We're not sure whether that's going to settle out because businesses have to decide how has productivity of their workforce changed when they've changed their location from working. That's not yet understood. And I'm willing to bet that in some cases productivity will have fallen. So compensation will have to fall relative to that productivity level. Other instances, it will have increased. So that the increase in real income that comes from that commuting will rightfully belong to the workforce. So I think that's all of those things are yet to be sorted through. And is there a chance of a policy mistake in the middle of that? Absolutely. I believe we will have a recession, especially if the Fed's tightens a couple more times. Because the banking issues are already introducing credit constraints. And there's a high correlation between banking sector credit constraints and economic activity. So, but he has made very clear that while they do have a dual mandate, that today, the part of that mandate that's getting focused is getting inflation back down. I agree with him. Inflation is the hardest on the poor because they do not have a portfolio of assets, they have cash. And if you're degrading the value of that cash at 7% annually, that's very hard on the poor. And so that's really the moral dimension of focusing on inflation and why today they're setting aside the employment side to focus on the inflation side. So I believe out of that we will get a recession. My boss is the chief financial officer, so I told her that at the next board meeting that I'm going to give the board members one piece of data that suggests strong growth, because that exists out there. One piece that suggests soft landing. One piece that says mild recession. One that says severe recession, and then have them vote. She thought might be a good strategy, but not necessarily her and Nancy. So yes, there's an argument that it could be much more severe, especially if it triggered failures by commercial banks because of the commercial sector.
I'd love to get a perspective on reverse mortgages.
They hate reverse mortgages, and I understand why. They're very inefficient products. The pricing, the variability in pricing is very wide. They're just not a great deal. So the question is, what else could be done in envisioning how you could either liquefy or deploy that equity for them in some leveraged way that would help them use it in their later years? We did some math in my group to try to see if we could present a market product that was better than the HECM that comes through the FHA. The terms there are still too lucrative. Even though it's not a great product, they're still would underprice anything that we can do that makes sense in terms of a market-based return. So that didn't work for us. So we're trying to envision what else we might be able to do to help. We're going to have a doubling of people over the age of 65 over the next 25 years. So it's going to be an important issue. The reason I use the phrase geospatial redistribution of real estate, not housing and not office, is because if people move from one location to another, then possibly distribution centers would have to move to reflect that change in where demand is, right? So you could get some of these warehouse facilities could see a change in pricing because of the change in the demographics in the market served by that product. So I don't think it's limited just to office or just to residential real estate. I think it's broader than that. Those other components I think will take longer to develop, so I wouldn't see them as an immediate trigger to a recession, but the office space could if it generated enough fear in the banking system that it really constrained. If failures in the loans in the office space raised fears sufficiently that banks seriously constrained credit, that could be a trigger. One of the things that was a policy change in, I think it was 2013, that is playing out today is the Fed put together the reverse repurchase program. So money funds can go directly to the Fed in the reverse repo market and get 4.7, 4.8% interest today. That's money that's taken out of the banking system. Prior to their creating that, if you moved money from one fund to another, those funds had banking relationships, so it still kept the liquidity in the banking system. Now it takes it out of the banking system. So one of the things that I'm watching is what's happening to the volume of money funds in that reverse repo window, and is the treasuries need to restock drawing funds out of the banking system or out of the reverse repo space? And it looks like it's coming out of the banking system, which would be a credit tightening in that space. So it is one thing that over the next 6 months, the estimates of how much the Treasury is going to want to raise range from $600 billion to $1.5 trillion. So that's a big range. So the closer they are to $1.5 trillion side, the more I believe there will be constraints in the credit provision. So important things to watch. It's also the case, I mentioned the Fed would like to back out of the MBS space. That's going to be a slow process because their portfolio coupons are so low that one's not really a worry today. And I don't expect them to sell, for the same reason that it didn't help Silicon Valley Bank. If the Fed sells, they'll be selling at a loss because current rates are up. But if you take part in the NASDAQ and take out the FANGs, the rest of it's flat. It's not a bull market, and easily can be reversed if you go into a recession. So I actually expect another leg down on the stock market as a fit. The debt ceiling debate to me was a discussion of political positioning. So the House Republicans were suggesting that it's important to get control of spending and get the budget closer to balance. Mind you, if you look at the last four presidents, all of them are guilty. So it pox on both of their health in terms of fiscal responsibility. But that was the position, part of the position that was taking place. In terms of how that decision will affect economic activity, very little impact on economic activity. So it was more about what do we think is important. The part of what's going on that will have an impact is what happens with student debt. So if the court rules that the program is illegal and people have to start repaying debt, our estimate is there's about 28 million households that will see an average of $400 a month in payments that they'll have to make, which is $7 billion a month, which is $84 billion a year. That's real money out of the demand side of the equation, and that would affect somewhere like 3 to 5/10 of GDP if that takes place. And we tend to think that the court is going to rule against that program. So just a couple of things. Most of the details in the budget agreement, like I say, were about making a statement about where we think. One of the things that troubles me about the bifurcation of the banking system into the too big to fail versus not too big to fail category is that it's taking place at a time when there is an explicit industrial policy being put in place. So the Inflation Reduction Act and the CHIPS Act are both industrial policy. So the U.S. is driving production not through market forces, but through policy to increase investment in a particular industry or industries. That tends to attract large institutions. So if you look around the globe, you'll see countries which have industrial policy as a force of their fiscal policy. There's an alignment between the large financial institutions and those firms who benefit from that subsidy to share the subsidy. My observation of the economic vitality of those two models is the traditional U.S. model is much more vital than an industrial policy model, particularly in the innovation space. So I would say that the move that direction is going to make it harder to quell inflation. I ended my comments saying that I would like to see a fiscal policy that was targeted toward income growth, not income redistribution, and investment to increase productivity. I think that's the key to the second question. There's a guy named John Cochran who's at the Hoover Institute that has done a bunch of work that suggests if fiscal policy is targeted toward income growth, investment in innovation, it makes it much easier for monetary policy to control inflation. It confirms a bias of mine, so you take it for what it's worth. Well, it's a famous statement somebody made is if you want to know what an economist really thinks, ask what they're doing with their own money. So if we're back to the CHIPS issue, I've for quite some time had money in the CHIPS space. I think that's a fundamental piece of so many things that we do in the economy that will be sustained for a very long time period, which I have had nothing in the chat, the chat GPT and all that space. I think there's a lot of at the moment, a lot of fluff in that space, to the point of the NASDAQ numbers running up. That is, in recent days, is very much a function of that phenomenon, which may or may not bear fruit down the road. I have a diversified portfolio. I have some cash because I do think there will be another leg down in the market, and cash is king when assets are on sale. So we have some of that in place. The treasuries, which you could buy, which are paying 10%, I have some of that. I think there's a limit of 10,000, but you can mix and match some other family member things and get something more than that. I do not own a single family rental. I'm heavily in real estate because my employment is in real estate, so I'm overweighted in real estate. So,
let me ask maybe a final question. Any comments on central bank digital currency?
I actually run a work group at Fannie Mae. Our intention is not to lead development in that area, but also not to be behind the curve, but rather to understand it. There's a lot of hurdles to it and a lot of challenges in that space, but we're having a conversation with lots of people in the food chain. One simple way to think about the potential is it costs the same amount of money to send a Western Union money transfer today that it did 150 years ago. That's not much progress. So it seems to me like there's some potential there. So we just want to make sure that we understand what's taking place there. I don't know what the Fed wants to do. The Fed certainly doesn't want to be a personal banker for anyone. And of course, neither do their clients want them to be that banks, so we'd be very good about that.
Well, I think the main social question is about the central part of CBDC, right? So in some respects, we have largely have digital currencies.
Oh, yeah, that's true. But if you take $100 bill into the grocery store and you spend it on food, the government doesn't know what you actually bought. And so that's the libertarian perspective on why that's not a great thing. And you can see that being but in China, they're tracking that. So it's not a myth or a uncommon concern. So,
and lastly, what do you think about our risk of losing the world reserve currency?
It's a ways off. It's a real thing. It's a very powerful tool to be lost very jealously, but it's tied to the comments that I made about the signaling in the debt ceiling debate about the level of debt that's being taken on in the U.S. economy. The more debt that we take on and the more expensive it is to service it, it reduces our flexibility fiscally and raises risks that will be harder to counter. And so there is a feedback from that to the reserve currency question. Thank you for being patient.
Thank you again, Doug. Thank you for all of you for coming tonight and making this event so successful.